Hey, what's up, people? You here with Sean, aka the real estate guy. With Innovate Real Estate Group in Delaware. And what I want to share with you, um, I was online earlier and talking to a realtor that seems not to know why things happened the way they did during the pandemic. And it's astonishing that people will say, I'm a realtor, but they don't really know their industry that they're in. I find that to be weird. I'm 10 toes down in this. Been in it, been around real estate for 20 plus years now. And I was an investor. I'm actually a bond investor, a person that bonds the bond and invests in the stock market. And I've already done all those fix and flips, buy and holds, rental properties. And I'm way beyond that right now. I can't tell you about my strategy right now that's basically knocking out the box. See, everybody thinks local, I think globally. So, what I want to reveal to you is what happened during the pandemic and why did the Fed do what they did. All right, and this is simple. You can go into any AI technology and type different questions and to get to the answer faster, right? So, first one I'm going to talk about is the pandemic. All right, so as you see here, right, what caused the Federal Reserve to lower the rates below 3% during the pandemic? And this was very simple. See, this is where education comes into play, right? I'm formally trained, went to school for business, specifically information systems. So I studied computers and business. So all this technology stuff, that's my world. You can say I'm one big geek, it just don't look like it. But the business side, also understand how to set up companies, also understand profit loss, understand market shifts and market changes, understands what drive markets, what lowers markets, understand what causes companies to go to bankruptcy too. Um, and typically, when you look at bankruptcy, that means the person was not very versed in business. I've never claimed bankruptcy, and I own several different businesses, and I have partnerships with others. So this is the reason why the Federal Reserve cut the rates below 3% down to nearly zero. And see, that's what people didn't realize. It was near zero. Most people that don't track this stuff don't know it, including the realtors that just sell properties. That's what they do. They sell it, but they're not very versed in the behind the scenes stuff. Most of the lenders, right? This is the part of the lenders. Lenders, that's their world. They cover finance, right? I'm not a broker. I'm not a lending broker. I am very educated in the background of this that whole environment, though. One of my friends, when we were in corporate America working for a financial company, he broke off and went into the mortgage arena. When he went to the mortgage arena, he basically taught us all. Taught us all. So during the pandemic, because the COVID-19 shock and threatened all of a sudden, right? Deep recession and potential financial crisis happened, and the Federal Reserve needed to support spending, credit, and market functionality. See, essence, they was trying to prevent us from going to a depression. Forget a recession, a depression. Immediate economic shock in March 2020, lockdowns and fear of virus caused output and employments to collapse almost overnight, with a sharp spike on unemployment and sudden stop in many sectors. Yes, many sectors got shut down. The Fed judged this as extraordinary negative demand shock that could spiral into a prolonged depression without aggressively monetary easing. So they took the pressure off of our economics, basically. Dual mandate jobs and inflation, right? Under its dual mandate, the federal aims for maximum employment and stable prices, with employment plunging and inflation pressures falling. It had room. Almost the obligations to cut rates hard. When they cut rates, what did it do? It spurred people to buy houses. And this is where I talk about the Federal Reserve based on what they say. What they say can cause reaction. It can cause people to buy, it can cause people to pause. And this has been going on forever. Because if you look, the news will then listen to what the Fed say, and then what does the news say? It's not a good time to buy a house. So when they did that, they slowed down people buying. When they said it was a good time to buy a house, then people went out there and bought. I bought another house in 2003, 2004. And at that time, they said these rates are the lowest rate ever. It was 6.3. So we're under 6.3 right now. So if 6.3 was low, and then when it went to 3 or 299, the only reason why I went there was because of the conditions. It would have never went there. Also, during that time, people didn't know about that word where they could forgo on their mortgage. That was always there. The public didn't know about that. Okay, so let's continue to read. In early 2020, credit markets started seizing up with stress in the Treasury, corporate bond, and funding markets. This raised the risk of a 2008 style financial crisis on top of the health shock. All right, if you don't know about 2008, so in 2003, 2004, they were giving away houses. They came out with the ARMs, adjustable rate mortgage. I knew what they were because as investors, that's the product that we used because we wasn't going to be in that house long. We didn't need no 30-year mortgage. We needed something short, less than a year. Get in, fix it, sell it. Get in, refinance out to something lower. Because then we're not paying interest on something that we're working on rehabbing at that time. It was a beautiful strategy. It helped control spending for all investors. All right. So look, let's continue reading. Near zero rates combined with large scale asset purchases and emergency lending facilities were meant to restore confidence. So you need confidence in the market. Keep markets liquid and ensure banks and companies could still access funding. That's that what I call like when you're looking at the news and they're talking about the weather pattern, the flow keeps everything flowing. All right, supporting recovery expectations. The Fed also signaled it would keep rates near zero until the economy was back near full employment and inflation returned sustainable to around 2%. To anchor expectations and encourage long-term borrowing and investments. See, you need the system to continue to do what it do. All right. So that's the reason why they did it. They were preventing ultimate collapse. All right. So let me jump into something else, right? We could see the way AI works, it could you we could ask these questions, right? We could ask those questions, right? But I'm not gonna go into that right now, right? What I'm gonna do is I'm gonna go back up further. So I want to reveal something to you. All right, so let's talk about current conditions. So I asked Perplexity. This is Perplexity that I'm using. I have another one that I pay for. And I use all these because I know how to use it. I've been using AI way longer than what it popped up on the news over the last year. All right. So is mortgage interest rates at 6.3 versus higher prices, price homes a better problem? All right, let's see what it says. A 6.3% mortgage rate with high home prices is mainly a monthly payment affordability problem. So notice what it's saying. 6.3 combined with the higher home prices, affordability problem. Because look, the monthly payment is what I teach my clients and my buyers. Don't even focus on the interest rate right now. Let's see if that house you can afford that monthly payment. Because if you can't afford that monthly payment, even at a lower interest rate, it's a mute point. You can't afford it. All right. So if you got a realtor talking about interest rates, you got the wrong realtor. That's not my position. That's not my job. My job is to help negotiate buying that house and covering all the terms and covering through that process and getting you through smoothly. That is my job. My lender's job is displaying the financing and the money part. They do, all my guys do a very good job. I work with all the top lenders, not those off brand companies either. These are the top companies listed. They're listed on Delaware State's housing website as recommended lenders. So when I built my business, I viewed that list first and I interviewed mortgage lenders from that list. Because if the state backs them, then I know they've been vetted. All right. So, and this is the way I run my business. I just don't work and throw anybody on you. If you want to come with your own lender, that's fine. Just make sure we get a second opinion to make sure what they're quoting you is accurate and we can get the deal done. So this is the reason why I never had a deal fall apart. Others may claim that, right? But I never had one. And I can prove it. All right, so let's move on. What is 6.3% means right now? Today, a 30-year fixed rate are hovering around low six range. So 6.3 is roughly in line with the current market rather than unusually high. All right. So also another thing about mortgage interest rates, you have a national rate, right, which is a survey done by the different lenders to see what numbers they're quoting as far as interest rates, right? And then that national rate might not be aligned with that local area. It could be a little lower, it could be a little higher. So you understand that part. All right. So the real squeeze is that rates are elevated compared to 2020, while prices in many markets have stayed high due to low inventory. Now, when I talked about this online today, I said low inventory creates high prices. The reason why, the basic class that we took in business, supply and demand. When the supply is low, the demand is high, you get to charge more. So you have these realtors back when the pandemic was going on. Oh, I got the highest price in the area. You didn't do anything, clown. The supply demand issue did that. The supply demand issue did it. Now do it in a regular market, and then you saying something. Then you got skills. But in a low inventory market where the demand is high, that's easy. So let me break this down so I can back up. Because see, when I'm talking, I can give you facts. So back when the pandemic happened, I had one couple, FHA buyer. We toured 20 houses. We lost all 20. I've never done that in the history of I've been a realtor. Normally, I can narrow that thing down and get it done within a week. I can find that house, get it under contract faster than all other realtors, and this can be verified by lenders. When the pandemic hit and all those people flooded the market and all those people are going for one house, that's what it creates. You would show 13 houses to 20 houses and get outbid by somebody that's a conventional buyer that had more money. Because that's what the market creates during those times. So lowering the interest rate, all that's going to do is flood the market with a whole bunch of buyers again, and our inventory situation has not been corrected. Statistics out there say that it's 4 million or 5 million houses short for the demand in this country. And here's the kicker. So the normal flow of people putting their houses up for sale is not happening because I think 80% of the people out there has a mortgage interest rate less than three. But many of those people that's in those houses aren't happy with those houses because they purchased and they rushed into those houses. So what's particularly going to probably happen is people are actually going to start to sell those houses, even with a 3% mortgage rate, because those houses have grown in equity so much, it could offset having a little higher interest rate on a new house. And we're starting to see an uptick on listings right now. See, I follow this, I track this. I'm up 2 o'clock in the morning doing this. All right. So let's move on to the next part, right? Uh so buyers will feel both sides at once for that particular situation. So why high rates plus hurt buyers? High price houses hurt buyers. High rates raise the monthly payment on every dollar borrowed. For example, recent CFBP data shows that the jump from very low to high rates adds added over 70% to the payment on a typical $4,000 house loan. When prices do not fall much as rates rise, qualifications limits tighten and debt to income ratios get stressed, making it harder for buyers to afford or even get approved for the same home. See, this system is very complicated. All right. So we can continue to read on. High rate slash low price versus low rate slash high price. This is my specialty. Research from the Dallas Fed shows that when rates fall, houses prices tend to increase. And this is what I said to this guy earlier. Your great president, he's a genius. He's real smart, but his grade point average doesn't reflect that. That grade point average is low compared to others that went to school with 4.0s. I mean, two is like you barely there. So you can't listen to somebody that's not qualified in economics to say the rates need to go low because you feel as though the rates need to go low because your polls are in the tank. Your approval rate is in the tank. So he thinks doing stuff like that is going to fool the public. But you got guys like me out here. We're going to educate you and tell you what actually controls interest rates. It's not the Federal Reserve Fed rate. Check out my other video. I'll put it in this video to go view it, and I'm gonna break that down for you so you understand that. All right. So let's go on. All right. The reason why it increases rates because demand snaps back, and the price effect can fully offset the payment relief from low rates. Okay. That means waiting for low rates can leave a buyer paying more for the house itself. And this is what I've been preaching for years. So total affordability does not necessarily improve, and you lose time building equity. Because while you was waiting, right, waiting for them rates to go up, but the price keeps going up. And you could have bought and then benefited from the price continue to go up. See, I know all about that because, uh, boy, I just went ahead and bought a house and built it myself. And I had to put up a lot of money to do so. Those first time home buyer programs wasn't, readily available back then. And I did benefit. So I set my family up nicely because of what I knew about housing. It goes back to me when I was 17 years old. So I was blessed to have an uncle that taught me. And then I had a realtor that mentored me. And then I had another realtor, top realtor in Berkshire, that mentored me too. So I'm very versed, and I'm gonna be honest with you. Making money is cool, but helping families build wealth is better, in my opinion. All right, so how to think about it as a buyer? If you can comfortably qualify, and the payment at 6.3 works for you, your budget and time horizon, buying now at a softer demand moment, more conscious concessions, less competition can be rational, with the option to refinance later if the rates drop. See, That's the same exact strategy that I gave to my buyers. Because why? That's the same exact strategy I used. So I do stuff, I perfect stuff, and then I teach what I perfected. Now, when it fails, I teach when it fails so that you don't have to go through it. All right. So if the payment is tight at 6.3, the problem is less the headline rate and more the combined effect of price, taxes, insurance, and your income. In that case, adjusting price point, location, or product, etc. 2 and 1 buy downs. Ooh boy, I know about that. 15 versus 30 years. ARM matters more than focusing on the rate alone. Man, that computer is smart. That AI technology is smart. All right. So hopefully you understood that. See, I don't teach people to focus on that rate. Not initially. We need to see if that monthly payment um you can afford it. Because you don't want to spend a certain amount of money on your mortgage versus your income. Many people, I've been hearing stories, they're spending 30%, 40% of their monthly income on a mortgage, and that's dangerous. You want it to be somewhere like 25%, 28%, um, something lower, right? The lower, the better, right? So if you really would like to, you're interested in buying a house, you're interested in buying a house in Delaware, look me up. I can take you through my program. I can teach you what other people are not teach you. I can actually share with you um, reviews from people that attended my seminar, and they talked about what I taught that other people don't teach. See, I give you the whole entire bigger picture. For me, this is not just about a sale. It's not about a sale. When I'm helping you buy a house, you become part of the family. I benefited tremendously from buying houses. I can teach anybody what I know, and I'm going to tell you the truth. So, hopefully, this video was helpful. Hopefully, you gained some information. Hopefully, the bigger thing that you learned from this whole thing is that you can go into AI and any realtor tells you whatever, you can verify it. You can verify it, right? So, be on the lookout for my other video where I break down what causes mortgage rates to go up and down. You'll be surprised. It's not the Federal Reserve rate. But I'll give you a tip. If you want to buy a car, be happy if the rate goes down from the Fed. It's going to help you out more in those lines. All right. So hopefully, if you have any questions, write it in the comments. Chime in. I want you to really um, ask those questions, and I'm personally going to answer them. So it ain't gonna be no bot. It ain't gonna be no computer.